Hi, and welcome to this special edition of the Macro Show. In today's episode, we're going to talk about how the creation of reserve assets through the process of quantitative easing actually locks up dollars in the system, and it's designed to actually strengthen the dollar, not debase it as most people believe. I'm your host, Steven Van Metre, and thanks for being here because this is going to be a very interesting special edition as we really get into the mechanics of how the banking system works, how QE works at a more granular level, and then how that actually is going to affect such asset classes like the dollar, like Treasury yields, and the consumer price index. Because when you understand that we're stuck in this liquidity trap that is created by the Fed from quantitative easing, it creates this odd demand for dollars inside the financial system. And when those dollars get trapped and can't move, well, they have some unintended negative consequences, and there's a few ways out, but I want you to see that we're far away from them and what it would take to create inflation, to actually weaken the dollar and have sustainable higher interest rates. So let's start with the banking system. How do we get a reserve to begin with? How does this process even start? Well, when people deposit money in a bank is obligated to pay interest on some of those deposits. Now, not every checking account is interest bearing. Some of them are, but savings accounts are. So the bank has to have revenue to pay interest on those accounts. Now, there's two ways they can do that. One is they can lend against their deposits and use the profits from, or the revenue from those loans to pay interest to the depositors. Another way they can do that is to take those deposits and actually go out and buy interest-bearing assets, such as U.S. Treasury securities. Now, why would a bank might do such a thing? Well, if they're not lending, then they certainly need to actually still have an asset that generates interest to pay its depositors. But the other reason this works is because most of the money deposited at banks doesn't actually leave the system. It just sits there and stays there. Only a relatively small amount of the money is moving around at any one time. So it gives the banks a lot of latitude in terms of what they want to do. If they feel it's a good time to lend, then they can go out and lend. And if they are nervous about it, they can go out and buy interest-bearing assets. So let's focus on the banks buying assets because lending really isn't a focus of where we're going with reserve creation. So a bank will take some of the money on deposit and buy a Treasury security. Now, most commonly, when they're backing deposits, they like to buy 12-month or less maturity Treasury bills or T-bills and upwards of 2 and 3 year Treasury notes. Now, they can go longer out the curve, but if you look at 75% of a bank's Treasury securities holdings, they're going to be 2 and 3 year notes and Treasury bills. That's their preferred asset. And why is that? Because it tends to be the kind of the average. If you average what the holdings are, how long money actually stays in the bank before there's a demand for it. So the bank will go out and take money and purchase a Treasury security, and they will call that a reserve. Now, if the bank needs cash, so let's say there's a demand from cash from its depositors, well, they could simply sell the Treasury security on the open market and get the cash. And that's why banks really prefer Treasury bills and upwards of 2 and 3 year Treasury notes, because they're highly liquid, they don't fluctuate much in value, and they can get money quick when they need it. Even if they're not expecting it, but if there is a sudden demand for cash, they can do it. Now let's introduce the Fed to this process, because the Fed now is going to do quantitative easing. And as we know, quantitative easing is nothing more than an asset swap. So it's nothing more than a reserve swap. So the Fed comes in, and we'll just say the bank is holding a 2-year Treasury note in reserve. The Fed comes in and says, okay, I'm going to swap that for an overnight reserve. So the Fed takes the 2-year note, puts it on their balance sheet so it's accounted for because it still exists. The federal government still pays interest on that note, so it does exist, but it's now held outside the system, and the banks receive an overnight reserve asset. So on their balance sheet, they still account for it. But the weird thing about this reserve asset, it's actually held at the Federal Reserve member bank, meaning the bank actually loses control over what it can do with that asset. So if there's a demand for cash, the bank cannot go out and sell that reserve asset. Only the Fed has the power to unwind that process through what we would call quantitative tightening. So the Fed now takes that 2-year Treasury note, puts it on its balance sheet, and the bank gets a reserve asset that's held at a Federal Reserve member bank. That is the process of quantitative easing. Now, when you grasp this concept, what happens is two important things. One, those Treasury securities that sitting on the banks or on the Fed's balance sheet, they can't leave the system. They can't be shorted. They can't be sold. The Fed is keeping them. Now, what does that really mean in the big picture? Well, the federal government through the U.S. Treasury is issuing debt every month. And the Fed currently, as of this video, is buying $80 billion of U.S. Treasuries per month, meaning they're just reducing the amount of new issuance every month by $80 billion. That's all they're doing. And depending on how those asset purchases are made up, they could be buying more of a certain maturity Treasury security versus another. But overall, the big picture is they're reducing the amount of new issuance hitting the market by $80 billion a month. Of course, as we know, the Fed has the authority to increase that amount or decrease that amount at any time. Now, on the dollar side, which is really our focus here at this moment, is those dollars can't leave the financial system. And that's what I really want you to understand, is because a lot of people think that somehow quantitative easing is debasing the dollar or printing dollars. It's actually doing the exact opposite, because now those dollars on deposit can't leave. And that's why quantitative easing creates a demand for dollars. It doesn't create dollars, it just needs them in the financial system, because if there's dollars in the financial system on deposit, the banks then can create a reserve by buying a Treasury security and then swapping that with the Fed. But once that reserve asset is created, those dollars cannot leave the financial system. They're locked down. And if money is locked down, I want you to think about this, it can't move. And that's where you get into the notion of what is inflation, right? So there's two ways we understand inflation. One is the creation of money. Well, how is money created? Well, it's created through the banking system. And so when people look at money, they assume that what we call the M2 money supply is all the money in the system. It is actually not just the amount of money on deposits. You see checking accounts, savings accounts, and you see what is called institutional money market funds, or what you would perceive as the money market account in your, say, 401ks, qualified plans, IRAs, brokerage accounts, things like that. So people look at this money supply chart here, and they see that it's growing quite rapidly. And it's currently sitting at just a little over 19 billion, just about almost 19 and a half or trillion, not billion, trillion. And people look at this and say, well, that has to be inflationary, because look at all of that money. And as soon as all of this money comes out of the financial system, well, it's going to be inflationary. So we have this perception that money creation is inflationary. But a lot of people don't understand where money comes from to get into the M2. There's two ways it gets there. One, it gets through the banks when they initiate a new loan. So money is created when banks lend, and money is destroyed when the principal payment of a loan is paid back. So we look and see, okay, well, what's going on with lending? Well, the easiest way to do that is to look at all loans and leases in bank credit at all commercial banks. And we can see on a year-over-year basis, it's growing at less than 3% a year and falling. On a 3 and 6 month basis, as of the recording of this show, it is negative, meaning it's in contraction. And likely in a few months, we will see the year-over-year rate of change go negative, which means money will be destroyed. That will put downward pressure on the money supply. In fact, it already is slowing the growth of it. Now, what's the other way money gets into the money supply? Well, from non-M2 sources. So when the U.S. Treasury borrows money, it borrows money from foreign sources as well as domestic sources. Well, money sitting in, say, a foreign central bank's account is not counted in our M2. So when it shows up in the M2, some people perceive, well, that is money printing. No, it's just money repositioning from a non-M2 source into the M2. So we perceive inflation to be money printing, which, as you now know, is not part of this process, even though we've seen the M2 money supply grow. But the process of creating that reserve asset locks that money up, and it can't move. So what's the other way we get inflation? Is when money exchanges hands really quickly. The more it exchanges hands. So you don't necessarily need a lot of money in the system. You could, but the other way it works is you could have that money rapidly exchange hands. And what's one way we can look at that? It's called the velocity of the M2. And the velocity of the M2 is expressed in a number of how many times money is used over a period to purchase a domestic good or service. And we can look at that right here. So we can see velocity of M2 is very low. Now, this should start to make some sense, because if dollars are being trapped in the financial system, as I've explained it to you, then that means those dollars cannot move. They cannot leave. They cannot create inflation because they are stuck. And as a result, we should see the velocity of M2 fall. And so far, that is exactly what we're seeing happen. So how do we know that this is actually what's going on? Maybe there's other forces. Well, one way we can look at the Fed's actions is through the monetary base. And the monetary base includes all the cash in circulation, which is a relatively small number of the monetary base, and all of those reserve assets. So those reserve assets that the Fed buys shows up in the monetary base. They update that number every month. So let's take a look and see what happens if we take the monetary base and we invert it against the velocity of money. And lo and behold, what we would expect to see is, starting after 2008, because remember, that is when we turned on the quantitative easing spigot and lowered interest rates, that we would expect to see velocity of money fall, which it did. And by inverting the monetary base, we see that there's a relationship there. In fact, based on the recent January monetary base data from 2021, it would imply that the velocity of money at the next quarter, because it's only updated every quarter, is actually going to go lower. So the idea that we're going to get inflation from quantitative easing is happening because the way the process works is it locks up dollars, and it does that to increase the value of them. Does that kind of seem interesting? Because if you have a pool of dollars and some of them can't move, they can't leave the system, they're stuck in the financial system, well, they can't be really used to do anything. That makes the other dollars more valuable. So how do you create more dollars in a quantitative easing world to get inflation? Again, it comes back to lending. That's why the Fed is so focused on lending. And you'll hear them say that banks can lend against reserve assets, which they can, although they're choosing not to at this time. So the only way you get inflation in a QE process is if banks are lending. And since they're not lending right now, and we can see that in all loans and leases as it's rapidly decelerating and headed into contraction on a year-over-year basis, we're not going to get inflation. Now, we know this because that is what happened in Japan. And we can look at the monetary base inverted against the consumer price index. So in red, I have the consumer price index on a year-over-year basis. And in blue, we've got the monetary base inverted, and you can see this nice relationship here. There was a time where the consumer price index did go negative, and it came back up, but you can see it generally is following the inverse of the monetary base pretty well. What this suggests is everyone that believes that the consumer price index is headed higher and we're going to see inflation, well, that's not going to happen. The actual result is this consumer price index is more likely to head lower than higher. And that's where we get into this liquidity trap. Because what the Fed has done is they've trapped liquidity in the banking system. Does that start to make sense now? They're trapping liquidity or dollars in the banking system. And so when you have a demand for money, which is created by quantitative easing on the monetary base side, that is growing faster than the money supply, well, there's a gap, and that gap has to be filled in one of two ways. Either prices need to fall, so the consumer price index would need to decline, or if businesses said, no, we're not going to lower our prices, we're going to keep prices stable, we're going to raise them and hold them there, then what you'll see in the economic data is demand will fall. And if demand falls, then eventually a business owner will lower their prices and the consumer price index falls. That's how quantitative easing leads to lower consumer prices. Again, what have we seen in Japan and in the Eurozone? They've done quantitative easing longer than we have and at bigger scales, and what are they doing? Fighting persistent either deflation or disinflation, and the United States will face the same problem. And we already are, but we're still at this phase where people believe that consumer prices not only going to go higher, but they're going to stay higher. In actuality is when prices do go higher, they will ultimately be rejected because the process of quantitative easing creates a liquidity trap. Now, what does that mean for the dollar? Well, we can look at the dollar against the monetary base and we come to the same conclusion. Now, while the trade-weighted dollar is affected largely by the euro and other foreign currencies, so it doesn't move exactly lockstep with the monetary base. We should see a trend that if the monetary base is heading higher, that we should see over time the dollar is headed higher, because again, given enough time, the Fed will trap those dollars in the system, as we've seen from the process. And if you have a deceleration in lending, as we see here in all loans and leases, or even worse, an outright contraction, well, that will lead to a stronger dollar. And that is the other part of the game of how this works. So you can see here they're both trending higher together. Now, a lot of people see this move here last year, starting in March of 2020, down to believe that the Fed's asset purchases are debasement, and they're not. The other will happen. So why is it critical for the Fed to have a stronger dollar? Well, how does the global monetary system works when you have the dollar as a reserve currency? Well, and how do you get dollars overseas? Well, it's really simple. When the dollar is strong relative to a foreign currency, an American consumer will seek to exchange those dollars for a lower cost foreign produced good and service, and that will move dollars overseas. Even better if the American consumer borrows those dollars, creates it from the banking system, and then uses it to purchase goods and services from abroad. So how do you make that process happen? Well, you can't do it with a weaker dollar, because then an American consumer is incentivized to buy a domestically produced good or service, and that does not grease the wheels of the global dollar cycle, or what we call world dollar liquidity. So the Fed needs to not only strengthen the dollar, but also lower interest rates simultaneously to encourage consumers and businesses to borrow money with their stronger dollars and spend it abroad. So now you see that makes sense. So how does this all line out for Treasury yields? Because that is the other strong belief right now, that Treasury yields are indeed going to head higher because we're going to see inflation. Well, that's not how this is designed to work either. So if you take the monetary base and invert it, and you put against 30-year Treasury yields, what you see is that 30-year Treasury yields follow the monetary base as shown inverted. As it rises, Treasury yields fall. And so every time yields rise, like we see here, against the monetary base rising, shown inverted, Treasury yields fall. And every time it happens, they fall. Every time they go up, they come back down. And right now, you have this belief that we are entering a secular phase of inflation that will last for decades. And what will actually happen is those Treasury yields that are rising will get reversed. Whether, again, it will come from the fact that we will not see businesses raise their prices, or we will see those prices rejected. Either way, there isn't enough money circulating in the system, because as you now know, that relationship between the monetary base and the velocity of money is pulling inflation down. And as a result, you'll see lower Treasury yields, lower consumer prices, and a stronger dollar. So now you understand that how reserve creation leads to trapping money in the system and creates that demand for money. The more QE the Fed does, the more demand for money it has on the other end. And as long as there isn't a strong demand for new loans, then what will happen is you'll see the money supply grow at a slower rate and fulfill this liquidity trap. Now, another way people believe is, well, if we do a lot of fiscal stimulus and directly give consumers money, well, that will fill in that gap. The amount of money that would have to be borrowed from a non-M2 source and given to American consumers to fill that gap is substantial. There would have to be so much fiscal stimulus every month to try to fill it. It's not going to happen. So when we do get fiscal stimulus, the reason it isn't inflationary is because of this liquidity trap. We see the process drying up liquidity and trapping liquidity, and then we get a little extra in, and then it gets sucked out. It gets put in and then sucked out. As long as the Fed continues to do quantitative easing and the banks don't lend, well, what you should expect to see are lower Treasury yields across the curve, a stronger dollar, and lower consumer prices. And ultimately, that will lead to lower stock prices as corporate earnings also fall. So I hope you found this video interesting and deepened your understanding of how the process of QE and the creation of reserve assets traps money in the financial system. And now you know why QE and why I remain as dollar bullish, bond bullish, and on the side of a deflationist or disinflationist, as long as the Fed's doing QE and we're not seeing the banks lend. Anyways, thanks for watching. I'll see you soon. Bye now. The content of this video provides educational information only. Is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation to buy or sell a security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.